Well, it was a one-way slide for the local bourse, closing down more than 1%, with the resource sector leading the way. I spoke to Martin Lakos from Macquarie Private Wealth earlier. Martin Lakos, Europe looked to be the main culprit for dismal performance locally, but any wash-up from the budget?
Yeah, Tiki, good evening. Well, certainly the Greek crisis that continues to emerge now, I think, is overshadowing the market, and certainly we saw the risk-off trades again taking place, with the materials and energy sectors well and truly underperforming in today's market, and the investors certainly voting with their feet in regards to heading to safety. Telstra once again was solid, so the telcos up, utilities and the banks, the high-yielding stocks, once again sort of outperforming. Now, to give you an idea of performance over the last 4 days, the XJO, that's the ASX 200 index, is down about 3.5% over those 4 trading days. The materials sector down 7%. So it gives you an idea of where the money's coming out of. I think there's some elements in the budget. I think one of the key things that the market might be questioning is the growth forecast. We're currently running at 2.2% GDP growth. Forecasts are for 3.25% by this financial year end, going to 3% for next financial year. That would mean this last quarter would have to have a significant lift in growth to get that rate up to 3.25%. That's probably not going to happen, which does put in question regards to the tax receipts that the government is relying on in this budget.
Now, how was the retail sector faring, given that there was a bit of a cash splash yesterday? Yeah,
look, the sector really didn't perform today. We still saw both discretionary and consumer staples down through the day's trade, which I think is just an overriding factor from the broad market sell-off. But what is interesting is, with that cash splash coming through before June 30, should it get through Parliament, is there is an expectation that some of that money will get thrown back into the retail sector, whether it's clothing, holidays, flat screen TVs. What is interesting, though, is that the government may inadvertently be putting the Reserve Bank, or letting the Reserve Bank put on hold its any future interest rate cuts. Clearly, the Reserve Bank will be watching to see if that, in fact, that kick-up in retail spending has a positive effect on the economy, and we might not see any further rate cuts until we see a decline in unemployment rates heading towards September. So we'll have to watch out for that one.
You mentioned Telstra. I see Telstra shares are the highest they've been since mid-2009. Is that all about dividends and safety?
You've got those stats absolutely right, Tiki. Now at $3.65 for Telstra, with cash rates at 3.75% and heading possibly towards 3.25%. There's clearly a real push by investors for sustainable high yields. In fact, on our numbers, if we're right for 2014, that dividend could go from 28 cents to possibly 34. That means Telstra is yielding still 9% based on a 2014 forecast.
Martin Lakos, many thanks for all that.
Thanks, Tiki. A pleasure as always.